Welcome to the deep dive. Today we're unpacking Robinhood, the company that really changed the game for retail trading. But they're at a fascinating point right now. Is this big push into crypto, into wealth management, even international markets? Is that a stroke of genius? Are they building a new kind of financial superpower?
Or is it maybe a really high-stakes gamble,
Yeah.
trying to outrun, the shadow of U.S. regulation and some of those past controversies?
Exactly. That's the core question we're diving deep into for you today. Our mission here is simple. Give you a shortcut to being genuinely well-informed about Robinhood markets, that's Asia Hood, on NASDAQ Q. We'll untangle their evolving business model, look closely at the competition, and dig into the numbers that really tell the story.
And just for context, all the data we're using is current as of June 30, 2025. The last closing share price we're referencing is $83.03.
Right. Now, to make this journey clear, we've split our exploration into two main parts. In part one, we'll cover the fundamentals, the core business, a look at leadership, and a solid financial analysis.
Then, in part two, we shift gears. We'll look at market sentiment, who actually owns the company, the risks involved, and wrap up with our outlook.
Okay, but before we jump in, just a quick note. This deep dive is powered by the fantastic analysis from Stock Analytics AI. If you find this valuable, please do like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on tickers.
And they're tackling the entire S&P 500 over the next few months, so members get that exclusive priority access. It's just $4.99 a month.
Or if you just want a one-off deep dive on a specific stock, you can always drop a super thanks. Okay, let's get started. Chapter 1. Business Analysis. Beyond commission-free trading. So, Robinhood's famous mission, democratize finance for all. But how do they actually make money if trading is commission-free?
That's the million-dollar question, isn't it? Or maybe $1 billion now. Their revenue streams have really evolved. The original story, and still a big chunk, is transaction-based revenues. This is where they route your orders, stocks, options, crypto, to market makers. Think Citadel Securities, firms like that. These market makers pay Robinhood a small fee. That's payment for order flow, or PFOF.
Right, PFOF. We hear that term a lot.
Exactly. And while it enables the commission-free part, the controversy, the real insight here, is the potential conflict. Are you, the customer, getting the best possible price? Or is the broker maybe prioritizing the payment they receive? That big SEC fine back in 2020. It tells you something about that balance.
How much of their revenue does that still account for?
In 2023, it was still significant, over 42% of total revenue. So, yes, still core, but controversial.
Okay, so nearly half is PFOF. What about the rest?
Well, this is where it gets really interesting. Net interest revenues have just exploded.
Exploded.
Yeah, it's actually become their largest revenue driver now. Almost half, 49.8% of 2023 revenue. And it grew an incredible 119% that year.
Wow. Where does that interest revenue come from?
It's from a few places. Lending out customer securities, charging interest on margin loans when people borrow to trade, and earning interest on the cash customers leave uninvested in their accounts.
So like a bank, almost.
Exactly. And that's the key insight. It's not just the growth, it's the shift. Robinhood has quietly become much more reliant on macroeconomic interest rate cycles. Meaning, if interest rates fall significantly, that huge revenue stream takes a direct hit. It's a potentially underappreciated risk for them.
Interesting. Okay, so PFOF and net interest are the big two. Anything else?
There's a smaller slice called other revenues. This includes things like Robinhood Gold subscriptions, their premium tier proxy services, and ACS fees.
ACS fee.
Yeah, that's the fee you pay if you decide to transfer your account out of Robinhood to another broker. Around 8% of revenue in 2023.
Got it. But they're not just sitting still, are they? They seem to be adding a lot of new features.
Oh, absolutely. They're aggressively building out their product suite, aiming to be that single, all-in-one financial app for you.
So beyond the core trading platform for stocks, ETFs, options.
Right. You've got Robinhood Crypto with its own standalone wallet now. You've got Robinhood Gold, that $5 a month subscription.
What does Gold get you again?
Well, quite a bit now. A high APY on your cash, currently 4%. Instant deposits, professional research from Morningstar, Level 2 market data.
Level 2 data. Explain that quickly.
Sure, it basically lets you see the order book, all the bids, and asks for a stock across the market, not just the single best price. It gives you a much deeper sense of supply and demand. Useful for active traders.
Okay. And the innovation doesn't stop there.
Not at all. They've launched new financial products like the Robinhood Gold credit card and Robinhood Retirement, offering IRAs with a pretty unique 1% match on contributions.
A match on IRA contributions, that's unusual.
It is. And it's 3% if you're a gold member, really pushing to capture those long-term savings.
And wasn't there a surprising acquisition recently?
Yes. February 2025, they bought Trade PMR. This is a big strategic move into the traditional wealth management space, providing infrastructure for registered investment advisors, RIAs, to use.
So targeting financial advisors now, too.
Seems like it, trying to bridge that gap. But what's maybe even more fascinating is their push on the international and crypto frontier.
Right, the tokenization news.
Exactly. Huge announcement in June 2025. They're launching U.S. stock and ETF tokens in the European Union.
Stock tokens, how does that work?
It's powered by a new proprietary Layer 2 blockchain they built based on Arbitrum tech. So imagine trading fractional pieces of U.S. stocks, like on a blockchain, in Europe. Pretty cutting edge.
Definitely sounds futuristic.
And alongside that, they launched perpetual futures trading for their EU crypto customers. It's a clear play to diversify revenue away from the U.S. and tap into global growth, potentially getting ahead of U.S. regulatory uncertainty.
Makes sense. So what about their market position and scale overall?
They have an impressive user count, 25.9 million funded customers as of May 2025, and about $255 billion in total assets on the platform.
That sounds like a lot.
It is significant scale, absolutely.
Yeah.
But it's crucial to put it in perspective. Compare them to, say, Charles Schwab.
The big legacy player.
Right. Schwab has more customers, around 36 million, but manages a staggering $10.3 trillion in assets.
10 trillion. Wow. So the average account size
Is vastly different. Robinhood's average is around $9,857. Schwab's is closer to $284,000.
that really highlights the difference.
It absolutely does.
Yeah.
And it points directly to Robinhood's long-term bet, asset migration. They need to keep those younger, smaller account investors as they grow wealthier.
So the new products, the retirement accounts, the Trade PMR acquisition, it's all about holding on to those users as their assets grow.
Precisely. It's a strategic imperative for them to capture that wealth journey.
Okay. So boiling it down, their primary value proposition is still that democratization of finance delivered through
Accessibility, zero commissions, no minimums. Simplicity, that mobile-first UI. Inclusivity, things like fractional shares. And they do invest in education with Robinhood Learn and their Snacks newsletter.
Got it. Let's shift to the broader industry analysis. What's the market looking like?
The global e-brokerage market is growing steadily. Projections are around 5.5% to maybe 9% compound annual growth through 2030.
What's driving that?
Key trends are the continued rise of the retail investor, especially millennials and Gen Z, the absolute dominance of mobile-first platforms, and of course the zero commission standard that Robinhood basically forced on the industry. Plus, tech integration, AI, robo-advisors, that sort of thing.
And the competitive landscape.
Fierce. You've got the legacy giants, Schwab, Fidelity, E-Trade, huge brand trust, massive assets, comprehensive products, and they've largely matched the zero commission offering now.
So that advantage is gone.
Mostly, yes. Then you have the other fintech rivals. Companies like Webull, known for more advanced tools, and Finance, Public.com, focusing on social investing.
Yeah.
Everyone's trying to find an edge.
But looming over all of this is the regulatory environment, right? Especially PFOF.
Absolutely. This raises the most important question, I think. PFOF is the single biggest external risk for Robinhood.
Why is it such a big deal for regulators?
It comes down to that potential conflict of interest we mentioned. Is the broker incentivized to get the best price for the customer, or to route the order to the market maker who pays them the most?
Like that real estate agent analogy.
Exactly.
Yeah.
And the SEC hasn't just talked about it. Remember that $65 million fine in 2020? That was for non-disclosure of PFOF practices and providing inferior execution prices to users.
Right. And there's a new rule proposed.
Yes, the SEC's proposed order competition rule, Rule 615. This could be a game changer. It might require orders to be sent to competitive auctions rather than directly to paying market makers.
Forcing more competition for the order itself.
Precisely. Which could significantly disrupt or even dismantle the current PFOF model in the U.S. And look at the EU, they're already moving to phase out PFOF by 2026. That sets a powerful international precedent.
So if PFOF is potentially under threat, what are the barriers to entry for new competitors? Why isn't everyone just doing this?
Well, it's still incredibly tough to break in. You have massive regulatory compliance costs just to get started. Building brand strength and, crucially, trust takes years, decades even.
And the big guys have scale advantages.
Huge economies of scale. Plus, you need immense capital for the technology, for operations, for everything. It's not an easy market to crack.
Despite those barriers, Robinhood clearly has competitive advantages. What are they?
Well, first is brand strength and recognition. Robinhood is practically a verb now, right?
Yeah.
That lowers their customer acquisition costs significantly.
Although that brand also carries the baggage of controversies like GameStop.
It's definitely a double-edged sword, yes. Second, cost advantages. Being digital first, no physical branches, means a lean structure. This gives them high operating leverage and those impressive gross margins, sometimes hitting almost 88%.
And network effects.
Yes, network effects and switching costs. Their viral referral program was key early on, and now, as they integrate more services, banking, retirement, credit card, it becomes stickier. Plus, there's that $100 AC case transfer out fee, the complexities of moving crypto. It adds friction to leaving.
Though competitors often cover that AC chase fee, right?
Often, yes, but it's still a hurdle. Finally, their unique assets. Their proprietary scalable mobile platform is core. And that huge user base, nearly 26 million, mostly younger investors, that's a massive long-term strategic asset.
And maybe that new blockchain tech.
Potentially, yes. If asset tokenization really takes off, their Layer 2 blockchain could become a significant edge.
Okay, let's pivot now. Chapter 2. Management evaluation, leadership at a crossroads. Let's talk about Vlad Tenev.
Right, the co-founder and CEO. His background is actually in building high-frequency trading software. That technical expertise was key to pioneering the commission-free model. He saw how it could be done differently.
But his leadership has been tested. Let's talk about the crisis response history. GameStop looms large here.
Okay, let's unpack this. January 2021, the GameStop short squeeze. Robinhood made that incredibly controversial decision to restrict buying of certain meme stocks while still allowing selling.
Which led to massive outrage, accusations of protecting hedge funds. Exactly. Widespread outrage. Tenev's public explanations, they were widely criticized as evasive, maybe not fully transparent, even though he maintained it was necessary due to clearinghouse capital requirements skyrocketing overnight.
Did it have lasting consequences?
Absolutely. It wasn't just bad press. There was a U.S. Attorney's Office probe. It did lasting damage to their reputation, particularly the democratizing finance image. It created a significant trust deficit they're still working to overcome.
Which brings us to communication transparency and ethical reputation more broadly.
It's complex. On one hand, they provide a lot of data and metrics to investors now. Very detailed financial reporting.
But on the other hand,
you have that 2020 SEC fine, $65 million for failing to disclose PFOF properly, and crucially, for providing trade execution that the SEC said cost users $34.1 million compared to competitors. That directly contradicts their stated values and, again, damaged trust significantly.
Okay, let's look at capital allocation. How are they using their money? The focus is clearly on aggressive growth and acquiring new capabilities, heavy investment in the core business, plus that strategic M&A approach we discussed.
Right, the acquisitions. Bitstamp, Trade PMR, X1.
If we connect this to the bigger picture, these aren't random purchases. Bitstamp hedges U.S. regulatory risk by expanding in Europe. Trade PMR is about moving up market, serving RIAs, capturing wealthier clients, retaining assets. X1 fast-tracked the credit card.
So a multi-pronged strategy.
Exactly. It's a targeted approach to de-risk the current business model and capture the entire financial life cycle of their growing user base.
What about returning capital to shareholders? Buybacks? Dividends?
Dividends, no. They're a growth company, reinvesting profits. No plans for dividends anytime soon. But share buybacks are a newer development and quite significant.
Tell me about that.
In May 2024, they authorized a $1 billion buyback program. Then, in Q1 2025, they added another $500 million, bringing the total authorization to $1.5 billion.
Are they actually buying shares back?
Yes, they repurchased $322 million worth in Q1 2025 alone. It's a strong signal of management confidence in the stock price, and it helps offset the dilution from stock-based compensation, which is common in tech firms.
Okay. And how efficient are they with their capital? What about return on invested capital, ROIC?
This metric tells a really interesting story for Robinhood. ROIC basically measures how well a company generates profit from the capital invested in it.
And for Robinhood?
After years of negative ROIC, deep negative in 2021, still slightly negative in 2023, it's shown a dramatic positive inflection, 8.99% in 2024 and nearly 20% on a trailing 12-month basis.
That's a huge turnaround.
It really is. It indicates that those strategic investments and operational efficiencies are genuinely starting to pay off. They're becoming much more capital efficient.
All right, let's dive into the numbers further. Chapter 3, Financial Analysis, the numbers behind the narrative. Key metrics first. Market cap?
As of June 30, 2025, around $73.27 billion. So firmly large cap territory now, which comes with high investor expectations.
And revenue growth, you said it's been a roller coaster.
It really has. Huge jump in 2021, then a decline in 2022 as market activity cooled, but then growth resumed in 2023, and a strong reacceleration in 2024, up 58% to nearly $3 billion. Quite volatile, but trending up again strongly.
Profitability. What about profit margins?
This is another huge turnaround story.
Yeah.
After years of prioritizing growth and posting net losses, Robinhood achieved an impressive 36.25% net profit margin in Q1 2025.
36%.
Yeah. It's a very clear indicator of the scalability of their model and the operating leverage they have. When revenue grows, profits can grow much faster, a stark contrast to just a couple of years ago.
What about cash generation, free cash flow, FCF?
FCF, the cash left after capital expenditures, is notoriously volatile for financial firms like Robinhood because of working capital swings related to customer balances and trading activity.
So what have the swings look like?
Huge positive FCF in 2020, then negative in 21 and 22, back to strongly positive in 2023, and then slightly negative again in 2024. It jumps around a lot, less reliable than for, say, a software company.
Okay. How about financial stability?
Well, the path to profitability, as we said, has been volatile, but the turnaround in 2024 seems solid and continued into 2025. Their debt-to-equity ratio is around 2.46.
That sounds high.
It might seem high compared to other industries, but it's actually pretty typical for a brokerage. A large portion of their liabilities are customer cash balances, which technically counts as debt, but isn't like traditional corporate borrowing.
Got it. And liquidity.
Their current ratio, which measures short-term assets against short-term liabilities, is about 1.41. Generally considered healthy, indicating they have enough liquid assets to cover immediate obligations.
All right, let's talk valuation analysis. How expensive is the stock?
Looking at relative valuation, the price-to-earnings, or PE ratio, is definitely high. Depending on the exact calculation, it's somewhere between 47x and maybe 61x trailing 12-month earnings.
And how does that compare?
It's a significant premium compared to legacy brokers like Charles Schwab, which trades around 19x earnings.
So the market is pricing in a lot of future growth.
Absolutely. That high PE reflects very high expectations for continued aggressive growth from Robinhood.
What about trying to estimate its intrinsic value? You mentioned DCF.
Right. Intrinsic valuation using a discounted cash flow model.
Okay.
The core idea is simple. A company is worth the present value of all the cash it's expected to generate in the future.
So you forecast future cash flows.
Exactly. Project future free cash flows determine an appropriate discount rate, the weighted average cost of capital, or WACC, which reflects the risk, and then discount those future cash flows back to today's value.
What kind of value did your educational model come up with?
Based on what we felt were reasonable assumptions, our educational DCF model suggests an intrinsic value range for Robinhood of $70 and $95 per share.
And what are the key assumptions driving that range?
Well, DCF models are very sensitive to inputs. We assumed pretty strong growth, 20-25% per year for the next 5 years, then slowing down to a more sustainable 3-4% perpetual growth rate.
And the discount rate.
We used a relatively high discount rate, 10-12%, to account for the elevated risks we've discussed, the regulatory uncertainty around PFOF, the intense competition, the revenue volatility tied to markets and interest rates.
Okay, $70 to $95 per share based on that DCF exercise. Let's move to part 2, starting with chapter 4. Market sentiment, Wall Street's view. What are the analysts saying?
Wall Street seems genuinely divided on Robinhood right now. The average one-year analyst price target is about $64, but the range is incredibly wide.
How wide?
The low target is around $40, the high is over $110. That's a 170% spread between the lowest and highest targets. It really highlights profound disagreement about the company's prospects. High risk, high reward reflected right there.
But you said recent sentiment has been bullish.
Yes. Despite that wide range, some influential firms have turned more positive recently. Goldman Sachs raised their target to 91 wonders. That's a buy rating. Compass Point went even higher, $96, also a buy.
Why the optimism from them?
They point to Robinhood's strong execution lately, the multiple growth drivers we've talked about, international, wealth management, new products, and potential efficiencies from their blockchain initiatives.
So a mix of views, but a growing bullish camp.
Exactly. The overall consensus rating might still lean towards hold or neutral, but there's definitely a vocal and influential group of bulls emerging.
How has recent news impacted things?
Mid-2025 news flow has been overwhelmingly positive, and the stock has surged. That big to-catch-a token event in June, the EU stock tokenization, the Layer 2 blockchain, crypto derivatives, it generated a lot of positive press.
Shifting the narrative?
It seems to have shifted the media narrative, at least for now, away from the older regulatory concerns and towards growth and innovation. Robinhood positioning itself as a forward-thinking fintech leader.
What about other market indicators, like short interest?
Short interest. The percentage of shares borrowed and sold short by investors betting the price will fall is actually relatively low for a volatile stock like Hood. It's about 3.97% of the public float.
Meaning
There aren't that many shares being shorted relative to the total available. And the days to cover how long it would take shorts to buy back all their shares is less than 1 day. So a GameStop-style short squeeze is highly unlikely here.
Okay. And technically, how does the price look relative to moving averages?
Technically, it looks quite strong right now. The price is trading significantly above its 50-day moving average, which is a classic bullish signal indicating a strong short-term uptrend.
And longer term?
It's also trading well above its 200-day moving average, signaling a solid long-term uptrend as well. In fact, the market recently saw a golden cross.
Golden cross.
Yeah, that's when the shorter-term 50-day moving average crosses above the longer-term 200-day moving average. It's generally seen as a confirmation of strong, sustained, positive momentum for the stock. Interesting technical picture. Okay, let's look inside the company. Chapter 5. Ownership structure. Who owns Hood?
It's heavily owned by institutional investors. About 1,356 institutions hold roughly 75% of the shares.
Who are the big names?
Major holders include the usual suspects like Vanguard, BlackRock, and Fidelity, FMR. A lot of that is passive ownership due to Robinhood being included in indexes like the Russell 1000. But you also see sophisticated quant funds like Renaissance Technologies among the holders.
What about insiders? Management founders?
Insiders own a decent chunk, about 8.3% of the shares, worth around $4.7 billion. Historically, looking back since the IPO, insider activity was mostly net selling.
Which is common after IPOs, right? Executives diversifying.
Exactly. Very common for executives and early investors to sell some shares gradually after a company goes public.
But wasn't there some recent significant insider buying?
Ah, yes. This is the big news here, and what's fascinating. On June 13th, 2025, a director, Christopher Payne, made a substantial open market purchase. 26,500 shares at $74.19 each.
And why is that so significant? Because it's the first major insider buy since Robinhood went public. Insiders sell for many reasons: diversification, taxes, buying a house, but they generally only buy stock in their own company on the open market for one reason. They believe the price is going up. It's considered a very powerful bullish signal.
Interesting timing, too, given the stock's run. What about ownership concentration overall?
It's quite concentrated. The top 25 stockholders own over 68% of the company. And crucially, the co-founders, Vlad Tenev and Bayu Pat, still retain effective control.
How?
Through their majority ownership of the Class B shares, which have super voting rights. Combined, they control about 63% of the voting power. Early venture capital backers like Index Ventures and DST Global also remain large shareholders, so decision-making power is still very concentrated.
Got it. Let's pull back and take a balanced view. Chapter 6, Risk Assessment. A SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start with strengths.
Okay, strengths. We've hit on these. Powerful brand recognition, even with the controversies. Highly efficient cost structure, thanks to that digital-first model. A large and strategically valuable user base, 25.9 million, mostly younger demographic. And a proven innovation engine consistently rolling out new products.
Fair enough. What about the weaknesses?
There are definitely significant weaknesses. That lingering reputational damage from GameStop and the SEC fine is real, potentially hindering trust, especially with wealthier clients. The revenue model volatility is a big one: transaction revenue tied to market swings, and now net interest revenue tied to unpredictable interest rate cycles.
Dual cyclical risks now.
Precisely. And relatedly, that relatively low asset customer base compared to legacy brokers makes them more sensitive to downturns in trading activity among smaller retail investors.
Okay, weaknesses noted. What about the opportunities ahead?
Lots of opportunities they're actively pursuing. Aggressive international expansion, EU, UK, fueled by the Bitstamp acquisition. Moving upmarket and asset capture using trade PMR, Robinhood strategies, the IRA match to retain users as they accumulate wealth.
Cross-selling.
Huge opportunity there. Building out the product ecosystem, high-yield savings, retirement, credit card to get more revenue per user, and potentially first-mover advantage in asset tokenization with their new Layer 2 blockchain, if that trend gains traction.
All right, that brings us to the threats. What keeps management up at night?
If we connect this to the bigger picture, one threat stands above all others: the regulatory sword of Damocles.
PFOF again.
Yes. A potential ban or severe restriction on payment for order flow in the U.S. is the single greatest existential threat. It would fundamentally disrupt a core historical revenue stream. They're trying to diversify away from it, but it's still huge.
What else?
Intensifying competition. Legacy giants have adapted. Fintech rivals keep innovating. It's a constant battle. Market volatility and investor apathy. Their transaction revenues depend on active markets. A prolonged bear market or just a period of low volatility would hurt.
And the macro factors.
Big ones now. Impact of macroeconomic factors, specifically interest rates. Falling rates would directly hit that large net interest revenue stream, impacting profitability. And as they expand globally, impact of geopolitical factors increases exposure to global tensions, differing regulations, things that can cause broad market volatility.
Okay, quite a list of threats. Let's bring it all together. Chapter 7, conclusion. The bull versus the bear. What's the argument for being bullish on Robinhood?
The bull case rests on several pillars. First, they are successfully transforming into a more diversified fintech company, not just a trading app. Second, they have a dominant market position with the next generation of investors, a huge long-term asset.
Plus the innovation.
Relentless product innovation and diversification. A clear strategic vision for de-risking, like international expansion, and moving up market. A newly profitable and scalable financial model showing strong operating leverage.
And the buyback and insider buy.
Yes, that $1.5 billion share buyback program signals confidence, and that recent major director purchase is a powerful validation from an insider. It paints a compelling growth story.
Okay, now paint the bear case. Why might investors be cautious?
Despite the recent success, fundamental risks are undeniable. The existential regulatory threat to PFOF remains the biggest overhang. Can they successfully pivot if it's banned or severely curtailed?
Valuation concerns.
Yes, the stock's demand evaluation leaves very little room for error. Any misstep could be punished severely. Their original core competitive moat commission-free trading has largely eroded as competitors matched it. Competition is fierce on all fronts.
What about trust?
Those reputational scars from past controversies could hinder their ability to attract and retain the wealthier clients they need for their upmarket strategy. And finally, as we stressed, the business is now exposed to dual cyclical risks, market activity, and interest rate fluctuations, making future earnings potentially less stable or predictable than bulls might hope.
Okay, so clear bull and bear arguments. Let's revisit the valuation summary.
Right, our educational discounted cash flow analysis, trying to balance that high growth potential against the significant risks, suggested an intrinsic value range for Robinhood of $70 to $95 per share.
And the current price.
As of our data cutoff, the share price was $83.03.
So right in the middle of your estimated range.
Exactly. It falls squarely within our estimated intrinsic value range. This suggests the market, at this moment, is probably valuing the company fairly, acknowledging both the exciting growth prospects and those substantial regulatory and competitive risks. Meaning it looks like a classic high-risk, high-reward situation. The ultimate investment outcome seems heavily dependent on management's continued execution, the success of these big strategic pivots into wealth management and international markets, and crucially, the final verdict from regulators on PFOF.
So a final thought for our listeners. As Robinhood matures, how will it balance that founding mission to democratize finance for all, with the increasing pressures of profitability, navigating complex regulations, and serving a potentially more sophisticated, wealthier user base down the line? What do you think? This deep dive on Robinhood was built on the extensive research provided by Stock Analytics AI. For more insights like this, remember to like and subscribe to the Stock Analytics AI YouTube channel.
Members get those priority deep dives, and they are covering the entire S&P 500 in the coming months. $4.99 a month for exclusive priority access.
And if you want a specific deep dive just for you, drop a super thanks. And please remember, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
Always do your own research. Or, better yet, consult with a qualified financial advisor before making any investment decisions.
Thank you for diving deep with us. We look forward to our next deep dive.